2020 has been one crazy year, guys, and a year with plenty of action. So before we were even a third of the year in, it was already one of the most volatile years on record. And now with 2021 on the horizon, I wanted to reflect and create a video on why it's so important to not lose your marbles when it comes to investing. I think we all know that saving money is not a great idea to build wealth. Don't just listen to that exclusively. It was never really a great idea, but it has its benefits, such as building an emergency fund when you need it in case the ceiling of your shower falls in. However, with all the money printing happening at the moment, it should be even clearer that saving money for wealth creation is not smart. So we are agreed generally that we need to invest, and invest we do, woohoo! So we invest and we become rich using our investment gains to buy those lovely cars and houses in the Hamptons. I think that's what the US call it, right? And all that jazz. No, I don't know. Personally, I've been working in the city for about 6, maybe 7 years now, and my partner around 15 years. So that's 21 years of our lives, guys. And the biggest learning lesson is that psychology plays a big part in how much your investment grows. So the hardest part, and one that most commonly haunts new investors, but also commonly older investors, is investment stress. Investing money is stressful, people, and this year would have blown the stress through the roof. There is no such thing as stress-free money, and investing will be stressful. It's just a given. At its core, generally, you're handing over your money for someone else to use to make better decisions on how to deploy it. Now, is that stressful or not? You tell me. And it doesn't really get easier. The more money you invest, the more stressful it becomes. However, that doesn't mean that investing is for monks and for those that have Zen-like control for stress. Investing is an invaluable discipline, so we need to learn it. However, we can prepare for the stress and learn how to keep calm and carry on. Or I even cringe when I say that. But we can also learn how to mitigate losses. So the first point I wanted to talk about is invest what you can afford to lose. So we hear this a lot, and for good reason. The easiest way to de-stress is to invest only money that you can afford to lose. If you set up your portfolio with that mantra in mind, then you know if the portfolio does go to zero, you can still live your life. What is wrong, scary, and a no-go is when that ability to work and pretty much generate cash flow is more difficult due to age, disability, or vulnerability, and where coming into money unexpectedly leads to investing with no backup plan. If your investments fail, can you go on with life, really? And this is quite a big deal. With all the apps we can now use for investing, it's hard not to be addicted to constantly checking your portfolio. I have a live spreadsheet, and at one point I was checking my portfolio every day and watching market news like a hawk. Yes, maybe I was awake at crazy hours feeding the babies at one point when I was doing that, but my eagerness to track, as noble as it was, does not really marry with my investment objectives, which is to invest simply passively and for the long term. So I don't trade, and all this constant roller coaster of movements on the volatility ride is not healthy, guys. So I deleted all my real-time tools and stopped my subscription to the pricing tool, deleted the app, and now reconcile my portfolios once a month. The truth is, nobody knows what's going to happen in the future. You just stick to the plan and get rid of high stress triggers. A quick tip, and building on the last one, don't binge on the news, guys. Watching financial news all day is silly. Again, it's designed to hook you in. They have it down to an art, trust me. Instead, what you need to do is read the updates and stay current, but don't binge. The next thing I want to talk about is having that emergency budget. One of the best ways to disintermediate stress and worry is to further reduce your dependency on your investments if things go down the drain. Well, how do we do that then? And the answer to that is with an emergency budget. So do keep some cold hard cash in your current account to cover in case something were to go wrong. Like, for instance, a global pandemic, which makes it harder to retain the same level of earning. And the typical rule of thumb is between 3 to 6 months of your monthly expenses, though it could be more. It's just whatever keeps you sane. And then align that risk to your personality. Now, you guys know me, I'm both risky and unrisky. I invest predominantly in equities through blended tracker funds because I feel I am young enough for at least the next 10 to 15 years. Following that, I'll start adding more to bonds and other lower volatility investments. I also invest in real estate to help build recurring income now. And I try and avoid a lot of asset classes. Options and derivatives all do sound sexy, but they're not for me. Digital currencies are another one. I appreciate the value proposition, but the volatility I can't stomach. Bonds, treasuries, I'm too young for those. Gold, on my wrist, please, guys. As an asset class, I don't really need it. Cash, it loses its value because of inflation, and that's me in a nutshell. Think about your appetite for a while and invest according to it. There are a plethora of investing tools out there which could help build a portfolio to your exact risk profile and time horizon. It's all very clever now with those algorithms, and I often play with the Nutmeg and Wealthify portfolio builders. These are UK platforms for having a diversified funds portfolio. Another quick tip is to stick to your risk profile. Believe me when I say that the hype out there is strong, there will always be the next wonder stock or asset class, and you'll lose your mind and FOMO will kick in. I have a video on FOMO, by the way. It's a must watch. I'll pop it at the end. Investing is not gambling. Avoid the trends and stick to the plan. Next thing I want to quickly mention is profit taking. Where you are investing in blended portfolios or a number of stocks, take profits or rebalance the portfolios. Rebalancing those portfolios also locks in profit and losses. Remember that point. 212 have the pie feature now, which makes it easy. Also, if you are using a platform like Nutmeg, again, don't stress. If you aren't investing in single stocks, it's quite easy to manage this. Just think about it whether you need to do it and build a rule to do so. My rule for my stock portfolio is to rebalance once a year. And recessions, guys, recessions are part of the course. Our economies are cyclical by nature, and as a scientist I can appreciate the natural decay or the Darwinian nature of it. What goes up, gravity must bring down, and our economies will flush out bad businesses and investors that have too much risk. Once you do accept the fact that the recession is part of the natural order of things, then it becomes an incredible opportunity to enter the market. Using strategies like dollar cost averaging helps mitigate market entry during a time of recession. And guys, stop calling it a recession in your head. Call it a correction. It was meant to happen. So to sum up, reducing stress during investing can be done. Diversification, don't have all your eggs in one basket. I use blended index funds, so I don't depend on one economy, for example. Focus on long-term strategy, so you eliminate all those short-term noisy bits. Don't get greedy. Investing is slow and steady wealth accumulation. And fourthly, prepare your mindset for recession and the opportunity it can create. Now, while the concepts in this video are pretty simple, I have linked some videos here to cover some of those basic principles I talk about in this video, and it would make a lot of sense to go watch them together. Enjoy, guys.